Hey, all right. Good morning, everybody. Welcome back to a new year. Um, I kind of set things up a little bit different. So if there's any audio issues, this would be a good time to let me know about it, especially if you're over on the YouTube. Speaking of YouTube, help me out this year. One of my goals is to grow that YouTube channel. I've been running these morning briefings for years, and I use that channel basically as a place to save my work, right? I don't really had not really put much into trying to grow out that channel, but we all need something to focus on, right? Think I'm gonna grow that channel out this year. It's a challenge that I'm stepping up to. So, do the usual, like, subscribe, share it with others that you know who may be interested in this. Even if they don't day trade, a lot of the topics we cover focus on where the market's going next in a bigger picture. So that alone should help. And of course, this year I'm going to be building out a bit of an academy on there. I think there's a missing section of material that could help traders. So we're going to develop that. It'll be on my YouTube as well. All right. So enough with all that stuff. Let's get into it. I was in media blackout through Christmas, and then we had the 2 days that we were back, and then I was in media blackout again until pretty much this morning. So, going to take a little bit of time to get caught back up. That's the first time since I've started trading that I completely disconnected from everything throughout the holiday. I got to say it was pretty nice, but now, of course, scrambling to get caught back up. The NASDAQ is leading the way. Small caps are basically flat. Now, you remember how we were ending things in the last 2 months? We were getting these overnight runs in small caps, and then they would kind of fade into the background, and the NASDAQ would take over once we got into the regular trading session. Well, we're certainly not in that regime, not now. We always want to be looking forward, asking the question, what's the market focused on? A lot of that, in the last few months has been the rate cuts. It still is a really big deal, but there's also something else now running towards us that we need to deal with. And that's going to be if we get a continuing resolution or some sort of solution to the government funding issue. The deadline is at the end of January. They may not be talking about it much now, but give it 2.5, 3 weeks, and we get, days away from another government shutdown. It's markets are going to care, right? So kind of keep that in mind. Austin, I appreciate that. Good to know that everything is running well over there. Hey, while you're there, how's the video quality? I put in a lot of work in the last 24 hours trying to get that up to 1080. And I don't know. Maybe I got it, maybe not. So the rate cut is an issue, certainly, if we're going to get one or not. But we also have to now worry about the government shutdown again. And I keep saying when it comes to this government shutdown, the threat is that we lose our credit rating and we get bumped down. Talk about the markets shaking it loose. If we get a credit downgrade, oh, the market's going down. Maybe a little bit of a flash crash, some shenanigans to the downside. It won't turn into like a whole bear market with, 18 months to the downside. It won't be that, but it'll certainly wreck any of your long calls unless you had a boatload of time on them and generally just cause a lot of chaos. So keep your eyes on headlines that talk about that government shutdown and where they're at. You know, how far are they apart? You got the Dow basically flat with small caps. The S&P is trying to split the difference between the NASDAQ and the small caps. Now, we usually see these two hanging out together. Point by point, yeah, the NASDAQ moves a lot farther. But when it comes to percentages, a lot of times they stay close together. Oh, I did get it. Austin, thank you very much. I appreciate that. So we want to see either the S&P catch up to the NASDAQ or the NASDAQ catch down to the S&P. One or the other. They should not stay this divergent all day. And maybe that'll be one of our tells when we get, near the edge, one side or the other. I had issues with Thinkorswim this morning. I was messing with a new options indicator. Thinkorswim doesn't do options indicators very well. Speaking of TradingView this year, I've got high hopes for TradingView this year. In the last part of last year, they started really getting uh, deeper indicators for options. And it's been the one gapping hole that traders like me refused to give up Thinkorswim to move over to be, full-time TradingView users, no options data. Not just the options data, but the sophistication of the tools. Thinkorswim doesn't really allow you to develop sophisticated options tools for, you know, really anything more than volume and price. And the new tools that I've been seeing over on TradingView for options already fantastic. And the more the year goes on, I think it's going to get even better. This is going to be an amazing year. All right, got to get the new spot gamma levels. I installed them on my other machine, but not this one. While we're waiting for those, we're back at the 10. The 10 and the 3 are crossing over right there. The white line and the blue line. So we're getting a 310 cross. But it doesn't have a lot of value for us since they're starting to tangle up like this. Always check the date on those spot gamma levels when I share them to make sure they're right. Okay, so we're above VWAP. We're hanging out at the 3 and the 10. We're above the 3-week, and we're above the 20-day. We're just like in this cluster. Now we've got a setup for a possible scoop pattern or a TRB. Really, the only difference between the TRB and an actual scoop is how long it takes to get there. The goal is the same, back up to the top of the range, but with a TRB, we'd pretty much make the whole move in a single shot. It seems funny, because it took 5 days to get down, 4 days, and we're talking about one day up. Usually, markets take a long time to go up and then go down really fast. The old phrase about taking the stairs up and then taking the window down. But in this scenario, we'd be taking, maybe a drone ship to the upside and taking the escalator down. So if it's a TRB, play, then the expectation is we get an inside day breakout and we make the run all the way back up in a single shot. Thing is, it doesn't have to happen today. We could sit and build another base inside of this and hang out here for 2 or 3 days, developing an IX10, and then make the jump. It would still be a TRB as long as we make the move back up in a single candle. It doesn't matter how wide the base, right? It can be like a V shape. It can be more of like a U shape. Doesn't matter as long as the run back is done in a single shot. If it takes multiple days to get back up there, then it's not a TRB. And we would focus on the shape of it. If it's a V or if it's a U, then it's a cup and handle, maybe a handle, right? It's a cup, scoop patterns. If we break lower than the 50, we're going to give up on the idea that this is in any way headed back to the upside, and we'll focus on what's next. So instead, we'd be looking at this as a little bit of a pullback, like 786, dead cat bounce, and the next leg lower. We don't have that yet, and because of the big bar here, if we're going to get a pullback, we need to set a lower high, somewhere up here, but not higher than this. This is just about technical analysis 101, right? If we come down here and we don't get that lift up first before going lower, then this won't count as a lower high. We're just going to have this low. So that's where we're at right now. Are we going to get that lower high or no? And are we going to just run back up again? Break the 50, which is this 50-day moving average. Then we're going to focus on 67.80. That should not be a tall ask, right? We should be able to hit that pretty good. We get underneath this, and we have the opportunity to come back to this, 6,600. There is a midpoint between all of that. Now, you might be wondering, why did I start here and why not here? Well, this is still the original measure. And we've gotten out of this original measure twice, but we haven't managed to get to the 111, certainly not past the 111. And we've come down and we've checked that midpoint once. So they're higher highs on both of these. We got a higher low. If we run up from here, we've got another higher low, which is fantastic. We're going to be looking for another higher high. But this is still the dominant drawing. And now you can see the 786. That matches the pullback that we're focused on. So break the 786, retest the half, which is basically that low we were talking about. Break that low, and we're going to focus on the real low, or the next low, right? Really real? Really real. That's what I'm looking at anyways. Running 64,000 in the overnight, it's good, clean volume, right? We're not lacking for participation, and it's not extreme. It is interesting that we really didn't do anything last night, right? Just kind of ground around through, we had Australia into Asia, then Europe, and really is nothing. But after Europe, we got above VWAP. We've been holding that. Yay! But that's really kind of all we got. And we're just right there at that 3-week, 3-day, 10-day So we got nothing but a market that looks like it's waiting on data. And, we come back to, well, what are we waiting on? We got ISM manufacturing and auto sales. The numbers are basically the same, so no discrepancy or nobody's aiming for an outside number. That could cause some shenanigans if we did get a displaced number or an outside number. Go away. We got auctions in the front end. So the 3-month and the 6-month, those they're not really going to be all that uh, helpful or insightful. You could probably just monitor those with IRX. And really, that's it, right? We got nothing. Except Japan hiking and continuing to hike. But, they've been doing a really good job of signaling in advance really well. All right, so for right now, March 18 is the FOMC that you want to keep your eye on. Sure, don't skip January, but the work that we've been seeing is to keep March steady at around this 50-50 chance. If it starts to significantly change outside of that 50-50, going to like 25 or 75% one way or the other, the market's really going to price that in. If we're just swinging from 40 to 60, I don't think the markets are really going to try to price that in too much. Now, January 28th, it's at 82. This should be fine down to 70. Anything less than 70, you should start to see markets reflect that. So that's pretty easy right there, right? It's not too complicated. It's only 2 dates. And you don't have to sit staring at those all day, right? Just kind of take a peek at them, especially after big news. We are going to get economic data today, as little as it is. So let that data come in, and maybe within 30 minutes or so, jump back over to FedWatch and see if the markets are starting to price that in. Easy peasy. So what we're looking at here is the ADR lines, the average daily range. This is my indicator. It's not the one from Thinkorswim. You can get all these indicators on YouTube in the video description. I share all these charts. I didn't share the individual indicator. I shared the entire chart, so you get every indicator that's on there. The average daily range to me is a better choice than the average true range. If you've ever read how the average true range works, it's a bit complex. It's more than just running an average of the daily movements, right? And I wanted something that was easy to understand and easy to calculate. So I developed the ADR for myself. It's not unique, right? The concept of an average daily move has been around for a long, long time. This is just mine. I'm sure if I'd have Googled it, I would have found plenty of other ADR examples. But when we think about what an individual market does on a day-to-day basis, think of the difference between Tesla and SPY. If Tesla makes a 5% move, it's just another day at Tesla, right? It's not a big deal. Tesla makes 5% moves all the time. If SPY made a 5% move, we'd be talking about it for a long time, right? Days and weeks. So that's something to really consider is how far does a particular market move on a day-to-day basis? For the ES, this is the average daily range, and right now that's 61 points. So from where we opened last night, we could split that in half, 30 points one way, 30 points the other way, and the distance between them at 61 points. All right. I mean that makes sense, right? We're not stepping off the curb on that one. If we was to go in a single direction, the full ADR, then from where we opened last night, we could move 61 points in one direction or 61 points in the other direction, and that would get us to the yellow lines. We're right in the middle. I mean, not perfectly in the middle, but we haven't gone anywhere. We haven't done anything, and we're not near one edge or the other with any dependency. So we have no edge there. One thing I like to look at on a day-to-day basis is where yesterday's high and low is and whether or not we can hit an ADR without getting an inside day breakout first. So think about going to the downside. We don't need to get outside of yesterday's low to hit this. It's inside with us. But if we wanted to hit the upper edge today, we got to get an inside day breakout. And that's not a real big ask right there because it's barely outside the lines. And 42 is an old school cog line. So could we hit it? Yeah, that's a given this time. But it's something that you want to look for when you're asking that question of where's the ADR lines today? And is it likely that we could hit one side or the other side or both? Believe me, stick around. You'll see it happens by the end of the day. So today, unless we get something that shakes the market loose, it's very likely we're going to be in a holding pattern and we got nothing. That means if we get to the edge, if we test yesterday's high and yesterday's low, then we want to focus on a reversal back inside the box. We have our Globex overnight range, and then yesterday's range, and then, of course, last week's range if we wanted to go with an even bigger box. So a breakout on the Globex gets us to yesterday's high. A breakout of that gets us into the 111 and the 1236. To the downside, we still got to challenge that half and get through there. Then the ADR half and the low of the day, and then a breakdown below that into 111 and 1236. So we got structure on either side, and depending on what makes us move to the edge, it's very likely I'll be playing reversals today. So if we do get a breakout, I'm going to play that it's a fake breakout and run it back in. Unless, of course, we get there on some crazy news and, and that it's obvious we're not done, then change it and go the other way. All right, today's floor pivot down here is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish. Then we ran right through it, so we don't have an MDP or anything like that. Today's floor pivot channel is really narrow, which implies if we did get a breakout, that we actually keep the breakout and run. Just keep in mind that these channels don't make price do anything. We're not going to break out or fail to break out because of a channel or because of these floor pivot channels. The next floor pivot that we saw up here is the weekly floor pivot. Generally speaking, we're bearish below, bullish above, but not just for the day, bigger picture on the week, and broadly speaking, throughout the index, bullish above, bearish below. The thing is, when we're crossing back and forth and we're inside that channel, it's like a neutral zone or a lack of bias. It's hard to see a bullish or bearish argument when we still haven't left the containment center, right? So let's get out of that. If we get out of it to the upside, we could focus more on long plays in the indexes and bearish below in the indexes. All right, R1 and S1. R1 is basically yesterday's high, and S1 is an inside day breakout, but just barely. It's almost like the line that we were looking at before this, right? The ADR half on the upside was just barely outside the top up here. So not only do we have ADR up here with this R line from the floor pivot, we've also got an ADR down here really close to this S pivot. Multiple levels of pivots right there at yesterday's high and yesterday's low. And so far today, no reason to think that we're going to break through those and get a run. We have to see how the news comes in. And so far, it's not looking like it's going to generate any excitement. All right, looking at last week's range, strong structure at 69.50. That's only going to be an issue if we actually manage to get back up there. And so far, and we're not doing that. So, yeah, maybe, maybe. To the downside, we've got multiple structures. They're not even half of what this other one is, but they are there. And then it's really thin down here. So this was more about exhaustion than any sort of defense as far as we could tell. And this is our current range that we got to deal with. Now, we haven't tested 6,900 to see if we're going to get any help there. That's the concern. If we don't get any defense or help at 6,900, then, 68 is on the table. Certainly 67.50 because we're running 50s and I don't see anything at 68.50. Not right now. So, last week at least gave us a lot in terms of looking at the week before that and how they were lining up. It's good to see that everything's behaving and doing what it's supposed to, right? technical analysis is based on looking at previous price action with the eye towards anticipation of future events. If the price action that we're looking at is unusual price action, then we are going to have a hard time using technical analysis on it, because we would need the unusual price action to continue rather than going back to the norm. So it's good when we look around and we see, yep, price is behaving the way it's supposed to, system's normal, nothing out of line, all good. 10-day, 30-minute volume profile and TPO. We got multiple structures here, nothing clean. We're not even going to get into the candles that made the current point of control for another 2 days. Now, last week we talked about seeing the point of control move to this location, 69.30, and I mean, we're there, yay, but now what? This is only going to move if we build out a higher area, or we take these candles out and by default it moves to the next higher area. It's going to be one of those two things, and right now the next higher area is 69.50. So we're going to see it move up 20 points. For that to change, we could get up here today, 69.32 today, put in more candles right here and surpass that level of volume. That way, when we start wiping these candles out, we're putting new ones in over here on the right, and we don't see the point of control move after all. Lots of resistance overhead and only one true area that looks like it might try to help us out on the downside. 68.87, which is the value area low on the TPO profile. That's really about all we got. I mean, 69.11 cog line, if you're looking at TPO, we got some help there. But it's slim pickings, right? Not a lot down there to offer encouragement or support. All right, the VPOC from the 18th, we took that out on Friday, so we're done with it. Friday doesn't have a new VPOC because we've already hit that level and worked through it. The thing about Friday's level is we opened and jumped right through it. So it's true, it's not a VPOC anymore, but it might still be an area of interest that you might want to pay particular attention to. The textbooks are going to tell you to mark these levels anyways, right? Whether or not they've been hit. The textbooks say take yesterday's value area high and low and point of control and plot them into today's trading session. And sure, you could totally do that. I'm not against it. I already have so many pivots that I don't need that. Still, sometimes it's worth marking them out, even if they have already been hit. So the POC from Friday, 69.02, is it really helpful? We're already looking at 6,900, right? It's not a surprise. 6,900 is a really important level, and we got 69.11 cog line, we got 68.92 cog line. Like, we got that area covered. Do we really need that point of control? That's on you, if you want to keep it or not. While we're also here and we're looking at yesterday's levels, we do have some structure from yesterday's Globex, and then to the downside, 2 speed bumps before we get to the low of yesterday. If we are looking for a move to the downside, then these speed bumps are going to be valuable to us, because we're going to want to highlight all 3 of these areas as potential places that we could bump on the way down. All right, our distance from 10, we're good. I mean, we're on it, right? We're not going anywhere. You probably can't see it in the video, so I'm just going to zoom in until we can all see it. This is where we're at. Not that other one that you can't even see now. It's off the screen, right? So we're at the 10-day. Subtle, right? When we're at the 10, it's not bullish, it's not bearish, it doesn't have any bias to it. We're in Switzerland and we need to move one direction or another to really start to develop a bias. One thing we can say is we're on our way back up and we didn't get through the half to the downside. And looking at our distance from the 10 week, we're at 1%. Usually I want this somewhere around 2.25. That's a kind of a good sweet spot. We're talking about 2.25% away from the 10 week, and we're not there. We're like 1%. It's okay. It's fine. We're still above the 10. So, we've got the broader bias of we're still healthy. We're still bullish. We're not really going anywhere. It's not like this is increasing. I mean, sure, this one's slightly higher than the last one, but it's not significant changes like it would be back here. So we're not distancing ourselves from the 10 yet, but we're not overbought. We're not overextended. We haven't moved too far too fast, and it doesn't owe us any sort of mean reversion. It's not like we needed this to tell us that. Price hasn't done anything. So, you know, from this, we're still healthy. Nothing's broken yet. So now we've got the weekly expected move. This indicator does a great job most of the time, but there are issues worth focusing on, and that includes contract changes, short weeks, holidays, that sort of thing. So if you're only doing the index and you're just doing, one or two names, maybe consider drawing your weekly expected move by hand. For those people that are doing equities, yeah, you're going to want to use this, right? You don't want to have to go in over the weekend and mark out 100 different names with their weekly expected move. This is close enough to close enough is close enough. It's worth mentioning short weeks, holiday weeks, contract changes. They can mess with this indicator. That's why we have this whole week was just broke, right? So we take the short week from last week and we compare that to the week that we have now, and we can see that this week's range is only slightly bigger than last week's range. Last week had less days. The analogy is if I could do 60 miles in 1 hour, how far could I go if I'm only going to drive for 45 minutes? That's 45 miles, right? Because I only got 45 minutes to drive instead of an hour to drive. Well, last week we only had, 4 days. So we had less time to move. We had an entire day and we barely got anything here. Markets may be pricing in a hurry up and wait scenario. If you've been around for a while, you know this scenario. It's where we expect the Monday and Tuesday of sideways, and then whatever event comes along and we finally break out and move. Big events are volatility suppressing, like FOMC, CPI, non-farm payroll. These are volatility suppressing events. And volatility is just a nerd word for movement. So if there's some big event this week that the market is concerned with, they'll price in that we go sideways into that event. For us, that means we can run iron condors and maybe strategic butterflies on a 0-day basis. And we can focus on staying inside the range and playing reversals off the edges. Now we can start with a hurry up and wait scenario, and then news come in that we weren't expecting and break that scenario, and then we get to running, and then you end up with a losing trade. So it's not to say that losses can't happen, because we all know losses can always happen. We just need to focus on the idea that the plan at the moment seems to be hurry up and wait. Now I'll dig around and see which event they are waiting for, and that's always a little bit of a guess, but typically we got an idea of which one is the high priority concern. Looking at what's down this morning, China's down and nat gas. Really, that's about it. The benchmark that we use is 0.5%. Oh, the Mag 7 down volume is down. And yes, that's a double negative for those of you who understand the math. Math is good. Looking at what's up this morning. What's up? The VIX. Bitcoin, lots of Bitcoin, more Bitcoin, uranium. The Mag 7 up volume is up. Chips, gold miners, energy, more gold miners, UFO, generic tech, quantum, uranium. Now I like themes. I'm a thematic player along with pivot points. Pivot points is basically my day trade style, and thematics is more of my swing trade style. Last year we had some great curves, right? It didn't last the whole quarter, it didn't last the whole year, but we had these themes that would come in like these swing scenarios. And quantum was a good one. UFO was a good one. Of course, we don't see it on here, but drones was a good one, right? So we had these recurring themes last year that showed up from time to time. One day doesn't mean anything, but seeing this speculative money or this overcrowded trade getting a little bit of attention this morning, I like it. It bodes well for a sort of rally day today. Money, being interested in taking risk. These sectors are the sectors that we need if we was to get a rally day. So at the bare minimum, we can't be thinking about a down day unless we get some serious news that we aren't getting right now, which, we can't anticipate or predict unknown news from hitting. So flat to higher is got to be the base case argument. And for me, I'm going to go with flat. We have everything here to run today, right now. And if that run starts, we're going to want to be asking, what is making the S&P move today? Is it, dollar yields? Is it 0-day options flow with dealer hedging dynamics? What, is it chips and small caps or Mag 7? We want to see that and have the why behind it. but we have all of them. And there's that rising tide that lifts all boats scenario. Maybe it's gold, maybe it's chips, maybe it's the Mag 7, maybe it's all of them, right? Sometimes we won't even get a why behind it. We just got them all and they're all pushing. But the way it stands right now, we do have them all and we got nothing, right? A slow grind to the upside with all of that. That's why I say my base case today is sideways, and I'll be playing the reversals off the edges unless or until something else changes my bias. So far, I'm positive, especially with the Mag 7 and gold and UFO and everybody up. But all of that combined, and we still can't get outside of yesterday's range. So we're waiting on something. Hurry up and wait scenario. It looks like it's going to be a pretty easy day, guys. Nothing in the trading world is easy, but it could be worse. So you got your levels. You're all set. Remember to like and subscribe over on the YouTube. Guys, help me out. And it does connect to my website, which has steps to the morning briefing. So if I'm going through this stuff and you're a little lost and you're wondering what the hell I'm talking about, or you want some depth or some background to it, hit the website. I've got blog posts that I've put together because the entire focus of this briefing is to teach you how to do it yourself so that you don't need me to do it. It's always been my goal. I don't mind giving you a fish today, but I'd surely rather teach you to fish for yourself. I'll see y'all tomorrow.